Well, I'm glad that you guys could join me today for this after Thanksgiving special from TradeThirsty. I have a pretty exciting topic for you. We are going to be talking about trade management. So I just wrapped up a boot camp this last, well, let's see, about a week and a half ago, where I talked about how to read the markets, looking primarily at price action. And we started to get a little bit into trade management at the very end of that boot camp. And I have had so many questions, so many people interested in continuing their education and getting more into looking at trade management. So I'm going to be giving you guys a little bit of a peek at some of what I do with the markets and how I trade, looking at everything from entries to exiting those positions. And that's what we're going to be covering today. So to begin with, a little bit about myself. For those of you that don't know me already, my name is Toni Hansen. I've been a trader full-time for over 20 years now. I got my trading start back doing swing trading stocks about, let's see, it was early 97, right at the beginning of 1997, and kind of made a name for myself trading a bunch of different markets. I kind of moved from trading stocks into doing futures, and took all of those techniques and applied them to forex, and basically I just trade wherever the market is active and wherever time frame I have time to now. So you can learn a little bit more about me going to CNBC. I've been on Mad Money with Kramer, taught for a CME group. You can find my articles in pretty much any major trading magazine out there. And of course, I've done most of the trading expos over the years as well. So, you know, there's a lot out there if you want a little bit of a background history on me. I don't just swing trade these days anymore, though. I do everything from scalping to position trading and really across a broad range of markets. So what you're going to find with me with my education is that all of the strategies and techniques that I'm going to share with you guys, they really can be applied to no matter what time frame or market that you're trading. So I know we have a lot of options traders in here today. We've got futures traders, forex traders. It really doesn't matter. You know, the things that we're going to talk about today really do apply to every single time frame and every single market. So you can take a break from trading, go visit relatives over some of the holidays and come back and nothing will change. Heck, you can take a break for a couple of years and come back, and it's really like riding a bicycle. So step away, come back, and everything works pretty much just the same. It's just that whatever market is hot right now can change. So, you know, right now things are going into like the cryptos, for example. That seems to be where we're getting a lot of new vibes coming in. But same thing, can take these techniques and apply them to those markets as well. So in today, we're going to cover a few things. We're going to look at how to limit losses on underperforming positions by using the correct stop and trailing stop techniques. We're going to be looking at how to accurately time targets that will hold with near perfect timing. I'm going to show you an example of that today. We're going to look at how to avoid being flushed out of winning positions, and how to hold on to those winning positions longer, and how to time upcoming corrections. And the first key that we're going to be looking at is correct entry and stop placement. So when you're first getting into a trade, the most important decisions that you're going to be making are where to place your entry and where to place your stop. Those that were in my boot camp this past month might recognize this chart. This chart is showing the risk of traditional trade setups. So this is a typical breakout strategy. You know, a lot of traders will use these strategies as some of the first types of trades that they'll trade, whether it's a bull flag, bear flag, or just like a gentle pullback within a range. They'll look a lot like this. And what you're going to find is that when you're reading up on how to trade certain strategies, a lot of them will say, well, you connect your highs and take a break of those highs, and that gives you your trading range breakout, or your break of your trading range channel, stop on the other side of that channel. The problem with that is that you're really, really limiting the return that you can have on your trades, no matter whether you are trading a traditional breakout strategy or you're trading some of the other strategies that might be based upon pivot trades or things like head and shoulders, basically any core strategy. When we look at this, we can see here very quickly how far did this move before it fell into a range again compared to what a typical breakout entry would be and a typical stop under the entire trading range. Well, obviously, if you're doing that, you have to have a success ratio of substantially more than 50%, because if you're only right 50% of the time, well, on something like this, your gains are probably going to be less than what you were risking on the trade in the first place. Obviously, that is a big problem. So what we have to do instead is we need to find ways of, even if we're taking strategies that, might not be a picture perfect, because how many of the strategies out there that you trade really are picture perfect? So we need strategies that, if we do get stuck taking a 50-50 trade, we need return on those investment that is going to be more than what we are risking. And that is a really important thing when I am deciding, is a strategy going to be worthwhile? It either has to be right 80% of the time or more, or it has to be able to make me at least 2-to-1 or 3-to-1 times what I am risking on the trade in order to be able to take it. Now, depending on the market, that can change. For example, if I'm scalping the S&P 500, the ES, then I might take trades that I'm only looking for a 1-to-1 return on my risk. But I have to take that trade where I am going to be accurate 80 to 90% of the time for it to be something that I'm going to be interested in. So we're going to talk today about ways that we can take setups that are less risky, where we can get more on what that risk is on our winning positions and eliminate some of the bigger losers. So one of the biggest things we look at is how to get into a position in the first place. When we're looking at trading a traditional breakout entry, you'll notice, for example, that there's a lot of waves of back and forth action within that trading channel. What I'm looking for to lower my risk on a trade is to see where things are beginning to narrow up and we're starting to see shifts in momentum take place. And that can allow me to take breakouts that might be ahead of a traditional strategy, and I can keep a stop that is tighter under the most recent segment of that breakout. So over here, for example, we have a couple of shifts in momentum offering setups that are a little bit earlier than we would be looking for on a traditional breakout. Now, we're going to look at today an example of a trade of mine from this morning. And I'm going to show you that in a lot more detail, how this can look in live trading. Because what happens is we can look at all of these picture-perfect textbook examples over and over again, however many times we want. And you go and look and try to find them in the charts, and then you have trouble trying to find examples that look like what those templates were that you were studying and examining. So, for example, this morning in the euro dollar, we had a market that was trading at the highs. Actually, let me switch over to the charts here. You guys can see what this looked like this morning. Here's a 60-minute. And what I was looking at was this trading range here. This was what we were seeing heading into the day. The market was coming up off of rounded lows, and it kind of began to slow, changed momentum here, and then fell into a little bit of a better consistent base. Now, obviously, when we compare this to the chart that I just showed you on the previous slide, where we were looking at a really solid base at highs, typical trading range back here. Let's go back and show you that slide. The one this morning looks to be a lot sloppier. You know, it rounded off going into the range. It didn't look like as pretty. And when it broke out, you'll notice that we didn't have a great shift of action within this range to indicate that it was really going to break to the upside and offer a strong breakout to the upside. So this is a trade that I actually passed on. Now, it happened right around when I got up this morning, which was a ridiculous hour I don't recommend waking up at, but it wasn't something that interested me because how this unfolded was it tried to break out of the channel a little bit early on, right as we were kind of rolling into today, and then we saw momentum kind of picking up on the downside, and then it moved really, really quickly back up to the highs. When we look over here at the previous examples, though, what I want to see is a situation where momentum is shifting, where we have a more gradual pullback, more gradual base. That is going to be more indicative of a stronger probability setup where we can get a stronger break to the upside without risking it being a trap like this, like right here, where it pulled up, broke above previous highs, and then came all the way back down, broke this previous low. Luckily, it didn't break the lows of the entire channel like it can do, and that is what often will flush people out. So you will have a lot of traders that will be looking for like a breakout from a trading range. They'll take a break from the entire channel, and then it will pull back into the range, and then they get flushed out just in time for it to take off and do what they were expecting to do in the first place. Now, there's many ways that we can avoid these types of situations. So I'm going to show you how I did that today with the euro dollar. So when we go forward and look at how this continued to play out, you'll notice that this doesn't even move to a level where it would have covered our stop for a traditional breakout. So it breaks here. You can figure out a little bit of, a flush action, try and get into a trade. Traditional stop under the lows. By the time it hits resistance, it's not even covering what the stop level is. And what I run into time and time again, and what I had to go through for years when I was first learning to trade, is that I would take these traditional breakouts and they would hit these levels just like this. And I would recognize that that's a resistance level. And I would worry, okay, this might not be even close to what I want as a larger target, but I know it's going to pull back. What do I do? How do I manage this trade at this point? If I had already been in this trade, a lot of the first things I would have learned to have done was move my stop to break even. Well, what happens when you move your stop to break even? Anybody? This is be break even. Yeah, you get stopped out. So I was getting stopped out all the time, right? I'd take the break even stop, I'd bail on the position, it would go just a little bit farther, and then it would turn around. Exactly what I was expecting it to do in the first place. But for years, I was taught if you have about as much as you've risked on your stop, you don't want to take a loss on that trade. Well, you know what, guys? That's not really the way to do it. No matter what, I hate using break-even stops. I want to use a technical stop. Break-even is not a technical stop. In fact, it's technical support when you were looking at a breakout on the upside, because more often than not, as resistance is breaking and you get a pullback, it's coming back into a support level. All of these highs back in here are now support. So your break-even level is right at the exact point that you really should not be breaking even whatsoever. So if I'm getting into a trade, let's just say that we did have a better opportunity to take this trade. Let's just say it pulled back really gradually, a nice gentle pullback, back and forth action right in here, hit a low right here. Well, my entry at that point would not be this break of highs. It would be this break of this trading channel. So I'm watching these bases and these periods of congestion, and I'm watching that momentum within it, and I'm looking for a shift in momentum where I have a more gradual pullback. And I'm going to get to this here in more detail in just a second. And the stop that I would use on this would be under the low of that pullback. So my stop would actually be here, even if the low of the entire range is over here. So what you have happening at that point then is that this becomes how much you're risking versus this. So you can very quickly take a breakout strategy where you are not increasing your risk by taking it before it breaks the previous highs, but you're able to take a position that is twice as large and still have that same amount of risk. So if you're trading, let's say this is like the Qs, and you take 100 shares of the QQQ, and you're looking at a stop that is this wide. Well, if this was the QQQ, you could then take 200 shares using a strategy like this, where it pulls back within the channel. And so now you have twice as much to play with. And if you're a nervous Nelly, and it goes and you see that resistance hitting up there at that point, it's easier for you to not second guess taking off part of the position at that point if you want to. You know, if you're a newer trader and you're just learning how to hold on to a position a little bit longer and building confidence in your system, then yeah, that becomes a great place at that point that you can protect some of your position, and that can make it easier when you know that a pullback is going to happen. Now, of course, with time, as you become a more advanced trader, you're going to be less likely to take things off at those levels unless you're a scalper, and that's all you're doing is you're not holding through those pullbacks. But if you're like me and you like to look for a little bit more on the forex pairs, then you can recognize, okay, that's a chance I can take some off, and I'm not worried about holding on a pullback now, you know? And as this moves higher and breaks these previous highs, at that point, you can move your trailing stop up. That's when you can take things and make it a little bit tighter, not before that. Now, when we move forward here and we look at what the traditional entry on this pullback is, this is where I'm looking to get an entry. So our previous slide here shows you the upside breakout of the channel. And then what we're going to look at is this pullback, because this is where this caught my eye. This is where I was able to get into this. Not over here, where we didn't have any nice shift in momentum, but over here, where we finally saw a bit of a pullback into the trading range. And this is another thing. A lot of traders will say, okay, well, I missed the trade. It already broke without me. What can I do at this point? I don't want to chase it. Well, if it pulls back into that breakout range, keep in mind that's that major support level, guys. That is where a lot of people are moving their stops to break even. That's where they're getting flushed out. If you have the opportunity to follow volume on your charts, you're usually going to be seeing volume dropping as it's pulling into that level. So let's go look at that pullback here in a bit more detail. So this is what we see here. Now, again, you have people that take traditional breakouts on the pullbacks where they use it as a bull flag. For example, let me grab my pen here, and I'm going to go back to blue. So they will connect ties and basically look for taking that channel break and looking for that breakout as their entry trigger. And, you know, you can see that it broke really fast right there when it broke. It went up super fast and then pulled back right into break even once again super fast. So that is, again, not the best place to take a setup like this. What I'm doing is I'm covering up. I don't see this action yet. This wasn't happening when I first saw this trade. All I could see was this pullback originally over here. And what I noticed is that originally there was some pretty sharp momentum on the downside. And I wasn't quite sure that this was going to be a pullback that would be viable. But when it bounced back up, came back down again, then we saw a shift and we saw momentum changing. And this brings us to that next key to a successful trade, and that is that it must have favorable momentum. A more gradual pullback within a larger correction is going to lead to the best odds for a successful continuation of the trend. So just like I showed you here just a couple of minutes ago, that's the type of thing that we're going to be wanting to look at on the smaller time frames as well. So here was the breakout, and you'll notice that originally on this 20-minute chart, the back and forth momentum was pretty comparable. We didn't have that shift in momentum yet, but then momentum increased. The speed of change at which prices change increased substantially to the upside. And following that, it began a much more gradual pullback. So that brought attention to this. And then when we go and drop down now to the smaller time frame intraday, we saw how that was starting to change even better. So here's the slide I grabbed earlier when I was entering the position. What I look for is not just that it retested the low right here. In this case, this particular strategy is called a 2B. Now, a 2B I refer to as two bottoms, but what I'm looking for is that second bottom is going to be a slightly lower low. So it creates a trap, basically. People that had stops under previous lows are getting flushed out, and it's a great level to look to position yourself in. What I need to see, though, is I need to see that momentum more gradual as it is pulling into that second low. So as that smaller channel breaks, that gives me the entry trigger now. Now, when I'm entering something like this is a 2-minute chart here. You can drop down even smaller. You can look at a 1-minute chart. You can look at a couple of tick charts, whether it's 100 tick, 50 tick, whatever. Anything that shows you the momentum action within that retest of that previous low is what you're going to be looking at. Now, let's say you couldn't see this setup early enough. Maybe you're newer to trading. You're trying to gain experience. You want to look for some better confirmation that yes, indeed, this pullback is going to hold. Well, a couple of things. First of all, you guys just came out of a Fibonacci class. For those of you that use Fibonacci fans, this is the 76.4% Fibonacci fan at this point. I'll show you that here on the charts. Let's see here. Can pull this up on the 2-minute really fast and show you guys. So we had additional support at that level. I'll switch this to a 2-minute. Scroll on over. Remove that, get that out of the way. So here is our uptrend that led into the pullback. And here is that Fibonacci fan support. So we have a really great level of support here that helped lead to that continuation on the upside. I also have, a massive Fibonacci course I taught years ago, and this is one of the things that we look at, are support levels that are going to help create these continuation moves. So when we look at this and go back to the slide, that support that we can see there helps with the timing for the trade. It tells us that, okay, by pulling into that 76.4% fan based upon this uptrend move here, that is a good level in time development. But if you don't understand time development and you're looking for another way to confirm a trade, you don't want to use a lot of indicators, maybe the indicators are a little bit confusing to you, then there's another way you can do this without worrying about the indicators. You can look for the momentum. And here is a greater momentum shift that begins to take place as this pulls off of that 76.4% fan level and the double bottom at that level. We can see that momentum began to shift. We had a really strong surge in buying here, came not quite to the upper end of this trading channel, but it pulled up a good deal. And then when it pulled back, it had a really gradual pullback. So we had a lot of price overlap from one bar to the next throughout this entire correction here. Nice little dojis here at the very end, some hammers forming right at support here, and then breaking to the upside. So the first continuation strategy on a new trend on the upside is something that I call a phoenix, because you're basically coming out of the ashes. You know, you're coming out of a downtrend where a security's really been beaten down and you're looking for it to break away. So when that happens, what we want to see is a move where it could be any type of move off of the low, and then that first correction. Ideally, you want most of that price action to be in the upper 50% of this move off of the lows, which you can see most of it was. There's a little bit of a tail here coming down, testing that 50% level, but our body and most of our price action is above the 50%. So that's really important. And that offers another opportunity to get into this trade if you missed the original 2B. So by doing this, we also have the opportunity to adjust the stop on the 2B if you took the 2B, and you can build into the position at that level. That's an opportunity to add on to a trade. And it's also the opportunity there to adjust that stop. So when this breaks out of that channel here, the smaller, slower, more gradual channel, you can then, at that point, move your stop up to under that low. Now, if you're taking that phoenix, your entry is that channel break, and you'll notice that compared to breaking out of the overall channel and placing a stop under the low of that channel, here to here, you're again looking at a position where you are taking about half the risk in terms of price compared to what you would if you were taking a normal trading channel, trading range breakout. So again, you can take twice as many contracts, as many shares if you're trading stocks, as you would if you were taking it based upon the wider range. So that gives you a better chance of being able to walk away from that trade with a gain than it would if you did not do it this way. Now, the third key to a successfully managed trade is, of course, having to deal with the exits of that trade and understanding where to get the target level, where to get out of the position, and that's where impulse moves come into play. So an impulse move is the primary momentum move within a security. So it's these major waves of back and forth action where the momentum is average to stronger than average. Now, in some cases, you're going to see that there are two impulse moves together within one larger wave. So you can get a smaller impulse move where it might pause just a little bit and continue the trend, giving you a larger impulse move, or you can just get a normal one like this that just goes back and forth. Now, a great opportunity to examine what those impulse moves look like is to go and scroll back on your charts and look over time. You know, what are average back and forth waves in a market over time? These are going to give you those average impulse moves. And that becomes really important when you're trading any sort of continuation move or breakout move, because we are going to be looking at target levels that, as long as the momentum coming out of the trading range is comparable to the momentum going into that trading range, you are going to be expecting about 100% extension on that move. So A and B will then be approximately equal. And this is one of the best ways that you can look to time targets on any type of breakout type of strategy. And of course, this means that even if you're taking something where you got like a 2T within that trade, 2T being a double top, here's the first high, second high is slightly higher than the first high, and you're taking a short out of that channel, you can still use what you've gleaned from the impulse moves beforehand to give you an idea of what that target is going to be coming out of that strategy. So same thing over here. You have an impulse move on the upside. You've got a trading range here. What's different? This impulse move has stronger momentum. When your impulse move has stronger momentum, than compared to how it had going into the range. So here's a little bit more gradual. Here it was stronger. Then you can have a target level that ends up being larger than what you might have been expecting going into the trade. So going into the trade, you may have been expecting that you're going to get a target level that's going to be about 100%. And then you find out, well, lo and behold, it ends up going further than 100%. And let me switch over to a chart that I can manipulate here a little bit better. All of my charts are set up a little bit differently. So when you're looking at these bases over time and what the target levels are going to be, here's an example here of where when the momentum changes, you're able to get more than that 100% level. It breaks, in this case, to 100% right here, and it hits that level, but it hits it really quickly. So what you'll notice happens is that even though it starts to shift momentum there, and it does pull back and correct, it's still able to continue higher. It's still able to push for a bit more. And that particularly will happen when you're coming off of lows, where you'll see that happening, where it can get a little bit more than you might have been expecting based upon the initial momentum move. But this is how I'm targeting these levels and these trades. So if we go back to that trade this morning and go back to our slide, and we look at this, you'll notice that on the 60-minute time frame, there's a couple of different impulse moves again here. So we have the smaller impulse move right here, and then there was a little bit of a base, but the larger one is this entire move here. And then we start to see momentum really beginning to shift at that point. So when we're looking at measuring those measured moves, since we don't have a clear cut, oh, it goes up, it goes straight over, and then it goes up, where we would do our Fibonacci extensions by 1, 2, 3. We're going to be looking at how these impulse moves down here can correlate to the extension and the price action up here. Now you'll notice I caught this right here, right as it hit that 100% extension. And I'm going to show you guys here in a second what happened when it hit that level. So this was the initial target level on this. It was right around 1.19. So that was the original target level that I had on this. The 2B that triggered the trade is right here, coming out of this little pullback here. And you'll notice right away that my target level is based upon what's happening on the larger time frame. It's not based upon that smaller little 2B itself. If it was, I would be using much closer targets because I would be scalping it. But instead, I was looking for a much larger target level based upon this being a breakout. Basically, this entire channel being a breakout. So I'm going to clear this here and show you what we have. So here's that 100% right here. And you'll notice that when it hit that 100% level, and that's the one based upon the smaller impulse move, you can see here's where I grabbed it, took off part of the trade as it was going into that level. And I'll tell you a second here what ended up happening with the rest of that trade. So as I had part of this trade coming into this level, usually I place my target levels on the books ahead of time so that as things are coming into a price resistance level, I'm having a better chance of getting filled. Whereas if you're waiting and to see how that resistance level hits, you might not be able to get a fill on it. So it's really important when you're using this type of targeting to identify where those levels of resistance are before they hit. And then as they unfold, you can manage them and change that management. So as this one hit, the momentum was pretty similar to what we had over here. Very similar momentum, in fact. So I figured, okay, you know what? Chances are that as long as the momentum on this breakout is the same as going into the range, that might stall it for a little bit, but it's probably going to try to still keep heading a little bit higher. So there's probably still more to come out of it. And I admit this got me a little bit nervous over here because when it hit that 100 level, you can see it stalled a little bit under it. It shifted momentum into that level. And this can be a little bit tricky because what often can happen at that point is it might widen up the range. It might pull back a little bit more, like to the 76.4% level. That's typical. And then it might, go and try to make those higher highs a little bit later, but I could be stuck holding on to something that could be pulling back a little bit. So I didn't get filled when it first hit here. Let me clear this so you can see my chart a little bit better. So I didn't get filled quite yet here. I got filled as it was coming into here. And at that point, it was already starting to shift momentum. So my mindset at that point is like, okay, it's going to hit this 100% level, but I need to be willing, if I'm going to hold any more of the position, I need to be willing to hold through a bit of a bigger pullback. Now, I was already anticipating that. Why? Because it had a bit of a pause over here in the first place when it hit that measured move. The market likes to repeat itself. So I was anticipating the fact that it could very well pause at that point. Now, the pause ended up being a lot briefer than I was expecting, for which I was grateful, but it did indeed pause there before it went and continued higher. Now, let me clear this here. And I'm going to pull up the larger chart here, clear this, to show you guys then what the measured move based upon the larger one looked like. So when we go and look at this entire move, whoops, grab that right low there. Okay, and we now look at, here is that original impulse move. Here's the extension of it right there. Here's our low of our pullback right here. And then there's the extension of that move. And what you'll notice now is that it came up into that 100% extension based upon the larger impulse move, which is more closer to what some of the bigger ones had been in the past. And that's where we ended up seeing that hold today. So when I go and look at the slide, let me go back to the slide here. I'm going to show you guys. Here is that 100% based upon the earlier level. And then here we have momentum beginning to shift. So this is the 100% on the smaller time frame, on the smaller impulse move. Here's the 100% on the larger one. And this is where we were seeing that momentum shifting. Now, I'm actually going to need to go to the 5-minute here intraday to show you this. So, clear that. And here's where we can see this was the 100% based on the smaller move. And this is where things began to slow. So at that point, that's where I was saying, okay, you know what? It could pause here. We could see it pull back. We could see it try to correct. It didn't end up doing it. It ended up holding here pretty well, pulling up. This is the 76.4 based upon the larger impulse move. So the larger one, just show you guys again really quick. That larger one is the one right here on the 60-minute. So there you can see the comparison. And then pulling into the 100. So what you're going to see here is that as it approached that 100% measured move on the larger 60-minute time frame, Here's that 100% remove right there. What we had happening was momentum was again starting to shift. So just like we saw the shift here as it went into the 100% level for the smaller impulse move, then we had momentum shifting again as it was coming up and going into the level for the 100% extension on the larger move. So that tells me, okay, you know what? This is getting ready to pull back again. And in addition to that, we have 3 evenly spaced highs as the momentum is shifting. This is something that I refer to as a momentum reversal. And while this isn't the textbook example of a momentum reversal strategy, it has all of the same types of concepts that go into it, where you're looking for usually a 2-wave move to highs, 3 moves at that point with 3 pivot highs, and then a correction. So that tells me, okay, you know what? As it's coming into this level, this is forming an equal measured distance here into this third high, and then I got what? A 2T. A 2T is, again, the reverse of the very position that got me into the trade. So it hits that high. It hit the slightly higher high. You know what? If you've got a reversal strategy forming, should you still be in the long trade? Probably not. No. So that's my clue. Okay, at this time, I'm out of here. I'm close enough to the target level. I'm not going to risk any sort of reversal on this. I can show you guys what this looked like on the 2-minute as well. We'll scroll on back here. And here you can see it hit that high, went in, shifted momentum. Notice this tail up here. This is really common on 2Bs and 2Ts as well. The 2T is 2 highs, 2T. 2B is the 2 lows, which is what the original trade was based upon. It's often normal to get this flush out because, again, people are getting flushed above these previous highs and above and under those previous lows. So those are typical traps for people to get stuck in. We want to use those traps to actually initiate trades and use them to take gains on trades and protect trades that we might already be in that are kind of turning around on us and we're like, oh no. So if you missed getting out on any of those previous moves into any of these resistance levels, and you'll notice, those 100% levels, they held to a T. The first one held, it led to a little bit of a base congestion. The second one, it held here almost perfectly. So if you miss those, you can use trailing stops as just kind of like your second backup if you missed it. But you have to really be careful. At that point, you're not wanting to use something like under a previous low as a trailing stop. You want to look for a breakdown or a shift in momentum, things like that help get you out of it. And what's interesting with something like this is if it's hitting 100% extension, I will often use, and I miss the exit, sometimes that happens. Sometimes you just don't get filled on your trade. I will use that pullback and then try to get out on the bounce itself. So I'm exiting into the bounce instead of waiting for the confirmation that it's going to break lower. But if you're newer, you can use those confirmations. So a couple of ways that you can manage those. And, there's a lot of ways to manage setups depending upon what your personality is, what your experience level is. Are you trying to build confidence in your trades? Are you trying to establish a trade where it's a longer term trade, but you're looking at just taking some things on the shorter time frames? Well, if you want to learn more about that, I have a boot camp that is just right for you guys this weekend. So it is going to be covering so many things here. And let's just recap here really fast. So far, we've learned that you must have correct entry and stop placement. You must pay attention to momentum, both for the entries and the exits. That momentum shift was really important with that exit, guys. And you have to be able to identify the impulse moves. So, are you ready for more? You want to learn more? Get even farther into this? I know you do. So, I had so much demand to follow up on the market timing bootcamp that I've put together a trade management bootcamp. And even if you missed the market timing bootcamp, which you can still go back and purchase, you can still come into this one new as well. So I will be talking to traders that are going to be newer traders, as well as those that are more advanced traders. So we are going to be meeting every Wednesday from 10 to noon, starting on December 13th. Every session is recorded, so if you can't make it live, it will be recorded, and you can ask me any questions you need to during, you can send them to me via email, and I will bring up the answers during the following session or respond back to you in email. So join me for this new boot camp starting here in just about 2 weeks, and we are going to be doing 4 weeks of live training, talking about when and how to enter a trade, not just like you got to see one of my trades today. We're going to be looking at when and how to enter a trade based upon a number of different types of strategies. And we're going to be looking at when and how to add into a position. So we're going to be talking about building onto positions. This is really good too if you're a newer trader and you might be a little bit hesitant in your entry and need to be able to build into a position. We're going to be looking at when and how to adjust stops, including trailing stops. When and how to protect your gains. So for example, like the strategy I taught you today was very simple because we were just looking for the 100% measured move. But what wasn't so simple was, did you place your extension levels correctly? Did you look at the correct impulse moves? Did you realize that this range here, even though it was moving up gradually like this, could be treated as if it was a trading range like this, that I managed this exactly the same way I would have managed a pullback. That's what we're going to be looking at. So we're also going to be looking at managing a trade astrophy. That is one of those fun little things that nobody likes to see happen, such as when you are in a position that goes against you the next day. Like let's say you are in a swing trade and it gaps down and it gaps past your stop, and then you are in big trouble because you are lost way more than you were expecting to risk in the first place. So we will be looking at examples of those trade astrophies where you miss the stops and now you are dealing with a loss, not just a regular loss, but a loss much more than you were willing to anticipate or expect. So if you think that any of these things can help you with your trading and help you do better with your trading, then I hope you will join me for my Trade Management Bootcamp. It is $297 for this weekend. In addition, I'm going to be offering a 30-minute private mentoring consultation with me. This is a $150 value. Usually when I do one-on-one, I do hour sessions, and they are $297 for the hour. So you're getting a 30-minute private consultation with me, and I'm not doing that to just the first 5 people that sign up. I'm doing that to anybody that signs up this weekend. So you get in there today, you decide, you know what, I've had a chance to look over what Toni has to offer and I really want to learn more about this, then take us up on that offer. Go to tonihansen.com/trade and get registered for that boot camp this weekend, and we will contact you. I'll contact you myself actually to set up that 30-minute consultation, and you can do it before the boot camp starts, or you can do it throughout the boot camp or after it's over. If you want to save that 30-minute consultation for the end of the boot camp to have it as a session where you can review some of the things in the class, where you might have some trades and market circumstances that are specific to your own personality that you need more information on and would like to learn a bit more about mistakes that you are making that you're trying to get past, you know, that's what that's for. So, you know, use it now, keep it for later. You can use it within 3 months of when you register. So I don't know what else I can say about that. You know, I think that that's a pretty good deal for you guys, and hopefully it will be a great opportunity for you to learn a lot more about how to manage your trades. Let me answer a couple of questions here, and then we're going to go ahead and wrap up. I know sessions are running about 15 to 20 minutes late here, so if you're here for the next one, stick around and he'll get started here in just a minute. For entry, do I enter 1 or 2 ticks above the first high bar? I will actually, it depends upon the time frame that I'm trading. So a lot of times what I'm looking at is what like an average bar is for that security, and that means like the average bar within a trading range or within a trading channel, and I'm using that break. So it's usually more than just 1 to 2 ticks. I'm usually want to see a good chunk of trades trade at that point, but the thing is, because I'm still entering within usually congestion itself, volume is usually on the lighter side, so I'm not fighting with a lot of people to get those fills, so it's still usually pretty easy to get into those. Thank you, Pradeep. She says, I really like your market-focused analysis. No secrets and no black box stuff. That is true. I focus on price action, and yeah, sure, I will add indicators like I showed you throw up, how to throw up that Fibonacci fan and using some Fibonacci tools to really give you a better visualization for where some of these target levels are. But they are confirmation tools. They're not something that I'm saying, okay, it hits this level, then I'm going to take the trade. No, it's just something that says, you know what, this makes it an even stronger setup because it does this. Okay, here's one comment. Most of the time it does not pull back. It just goes on without you. Yeah, so, you know, some of these breakouts, you might not have the opportunity to get in on a pullback. And that's why when I'm looking at those periods of congestion, I'm looking for the opportunity to get into it before it offers the breakout. Now, in the case of the trade today, there wasn't that opportunity. I was not paying attention, not awake enough around 5 o'clock this morning to look to see if it had anything going on the smaller time frame. So all I had to do was rely on that pullback. Now, if you don't have a pullback, if you're looking at a trading range, then this is where looking at that momentum within the trading range is so important, because usually you have these back and forth moves and you can identify periods in time within the congestion where the momentum is shifting and you have this more gradual pullback within the channel itself, because when it breaks that channel and it gets up here, you might not have another chance for a breakout, for a continuation. It might not offer that pullback within the channel. So I got lucky this morning and it had that opportunity to do so. And a lot of times if breakouts are a little bit too early, then they will have that greater propensity to pull back into the range. It's just another way of trading these breakouts though. So yeah, not all of them are going to offer that opportunity. So you have to know what opportunities will they offer and be willing to take whichever one it is that ends up developing. So this is the first one I want to take, but if I miss it, then I'm going to be looking for that pullback to take that, especially if my target level is up here and I know that I have a lot more room for it to go. All right, guys, I'm going to go ahead and wrap up today. So thank you so much for joining me. If you have extra questions, please drop me a line at info@tradingfrommainstreet.com. I will put that here in the box, info@tradingfrommainstreet.com. Patricia, I got into trading quite on accident. I was actually an artist and an archaeologist and kind of got thrown into the markets. Started helping somebody else out with their analysis. Really enjoyed it. I loved the puzzle solving, and it went from there.